Firstly, thank you so much for inviting us to speak with you all today. I think it's fair to say that uncertainty has been a theme that has very much defined the 2020s so far. We have monetary tightening and loosening at different stages across the world at the moment, moving at different speeds, and certainly regulatory change on the energy transition also moving at different speeds as well. It's not just on the regulatory front, on the technology side as well, there is a lot of uncertainty. This is a picture from a pilot green hydrogen project in Southern America, where we have some very early stage production happening, but still many projects announced in the pipeline failing to secure financing, failing to secure offtake, and certainly a lot of questions around the viability of the sector. The transition is also creating a lot of winners and losers when it comes to company strategy. There are opportunities emerging for new automakers to enter given the wave towards electrification, but still the question on business strategy and long-term prospects is still highly uncertain. Lastly, we're in a huge phase where physical risk and the uncertainties around this theme are really central to how people think about long-term transition. Wildfires, floods, and extreme weather events, like the ones seen in LA earlier in the year, are defining how people are starting to think about their long-term planning around the transition. But with all of this uncertainty, one thing in the 2020s has been true. We have seen a continued upswell and increase every single year in investment into energy transition activities across the economy. This keeps breaking new records. Last year, we saw $2 trillion of investment going into energy transition around the world. That was 11% up from the year previously. It was also the first time where at BNEF we saw electrified transport spending actually outpace investment in renewables. So that's a huge signal on this pace of consumer activity as well when it comes to transition activities. From our perspective here in Europe, we still held our ground last year as the second largest region for energy transition investment around the world, still pipping the US despite changes like the Inflation Reduction Act tax credits coming in. But we still lag very far behind China, which attracted nearly 40% of the global total last year. Now, if we normalize that for the size of economy, China still dominates. So 4.5% in equivalent terms was that size of energy transition investment compared to GDP. The EU ranks at just under 2%, Germany was at 2.3%, and you can see the US, perhaps unsurprisingly, given the size of its economy, at 1.2%. Now, it's also becoming clear that there are two speeds occurring in the energy transition. So this is a story, firstly, between technologies. So the vast majority of the investment that we track at BNEF today is going to those mature sectors. So where the technology is proven, the commercial scalability is there, and the business models are established. So think of things like renewables, grids, energy storage, and electric vehicles. Those sectors grew 15% year on year, reaching that nearly $2 trillion mark. If you remember, that's nearly the majority of everything that we've tracked. If we contrast that with the emerging sectors, we have a very different story. So these are technologies where typically either the economics are yet to fully stack up, or we have some still infancy and question marks around the viability or a reliance on policy. Those technologies, so think carbon capture and storage, think electrified heating, think clean industry and CCS, these actually saw a contraction year on year of 23%. Now, it's not just on the technology side where that two-speed transition is playing out. We see this happening in regions moving at different paces as well. So while China achieved a 20% year-on-year growth last year, and the rest of the world also moved up 25%, in Europe, we saw a very different picture, with a contraction of 7% in investment into the energy transition. That was driven by a few big things across multiple sectors. One of the more notable ones for the perspective here in the UK was on the offshore wind financing side. So we saw a contraction of nearly 2/3 year on year from 2023 to 2024, with a lot fewer deals happening not just in the UK, but also in markets like Poland and France. Now, this isn't really atypical for a sector like offshore wind, where there generally is a lot of year-on-year variance, as you can see in this chart. That's really due to things like the timings of when government auctions are run. So no surprises here in the UK, where we had that lag with the 5th auction round of its renewable energy programme securing no bids, that we had a bit of a downturn for the sector. Heat pumps also had a significant downturn year, with consumer spending on the residential side dropping by almost a third across the region. This was due to changes in subsidy programs in key markets. So we had reforms happening in France. There was a rephasing of applications for Germany's federal subsidy scheme. And maybe by surprise to most people, including myself, the UK actually saw a really bumpy year with 12% growth, still relatively small in investment terms overall. But our boiler upgrade scheme here has helped to secure that market to being a size of over $1.2 billion. Now, despite all these kind of changes in the fundamentals and headwinds facing European markets, I now want to share with you 3 considerations or ways of thinking about the energy transition here in Europe and what lies ahead. The first thing is that consistently at BNEF, our research finds that the long-term fundamentals for the power transition remain strong. The cost of clean power technologies, this has been mentioned already several times today, should continue to recover and decline globally. This is due to falling equipment costs, cheaper cost of capital, and technological improvements. Offshore wind and battery storage, as you can see here, are due to decline at a rate of between 9% and 11% next year. And that's due to continued improved changes in how the financing costs and these kinds of things are helping improve things for the sector. There are also, if we look in the longer term, further cost improvements and efficiencies that can be made over the coming decade. So you can see here a range between 24% for onshore wind, 15% for offshore, and 29% and 43% for battery storage. Some of this is being driven by continued scale in deployments and changes in China. But globally, this story of continued technological breakthroughs driving costs down is true. This is, of course, not just theoretical on the cost side. It's actually attracting companies to think about how to reduce their energy costs. So more and more companies, PPAs have come back into vogue as a topic. We will be talking more about them today. More and more deals are being signed. We've tracked now 70 gigawatts across the Europe, Middle East, and Africa region now to date, of which half of that volume has been signed just in the last 2 years, so since the energy crisis. So this upsurge in off-takers actually taking to the market and signing these deals. Now, it's not, in Europe, just a story of big tech companies signing these. If we look at the breakdown of the types of off-takers are actually signing these deals, we have everything from materials, manufacturing, industrials, and even service sectors signing these deals too. This is all data, by the way, deal level that you can pull from the BNEF platform. Now, when we look in a long-term perspective about where this goes, where do these continued cost improvements take us? At BNEF, we find that falling technology costs, as well as the all-important combination of rising carbon prices on electricity generators in the region, are driving really important tipping points in the fundamental outlook for the power sector. So already it's true today that on a per megawatt hour basis, building a new wind or solar asset is actually cheaper than running even most efficient existing coal or gas-fired power plants. And that's true in much of the region. As a result, these technologies see a massive continuation in the growth of their deployment in the region, reaching 60% as soon as the 2030s. And you can see that that helps to contract the need for thermal generators, so that bulk generation from wind and solar, compressing the actual upside for generators producing through either coal, lignite, or gas. That drops to below 7% by the mid-2030s, even in our base case outlook. So that's just looking at where the costs get us, the fundamentals, and not really forcing a climate outcome or anything else, just looking at the fundamentals. Now, this isn't just conjecture into the future. We see real impacts of what wind and solar do for our markets in reality today. So we had a period of extreme intraday volatility across European energy markets in the 2022 period. So gas prices really causing that extreme volatility in the middle of this chart here that you can see. Now we have a slightly different picture come 2024, where more and more solar deployments, especially in markets like Germany and the Netherlands, as well as the increased occurrence of negative pricing, driving up intraday spreads and actually opening up opportunities for things like battery storage to make revenues through the arbitrage there. Now, it's important to remember that it still takes a lifetime of maybe around 110 euros per megawatt hour for an average 2-hour duration battery to make sense in the region. But this is interesting if you're thinking about the business opportunities for these new technologies, especially as a result of increased solar generation. So while the fundamentals are looking quite good, where are we if we think about where we need to get to in order to achieve some of the climate targets that European governments and regulators are trying to drive the market towards? I just wanted to point out two of the biggest potential risk sectors, and that would be wind and the grids. So just here you can see the average investment that we tracked across these sectors in 2023 compared with what we need to see in those sectors for the rest of this decade in order to get on track for net zero. And you can see that for wind and for grids, that multiple is nearly 70 to 80% increased investment from today. You might ask why I'm not saying about storage. That 3x multiple looks pretty chunky. We are actually seeing the project pipeline drive up in our base case towards that level, whereas we don't really see that as being the case for wind and the grids. So if this picture doesn't change, there is a real risk that we get to an overshoot. What does that look like? Here's your emissions for the European region. You can see in the solid line at the top of both of these charts for the EU and for the UK, that base case assumption on where the energy-related CO2 emissions get to is nearly a third overshoot on the climate targets by 2030. So that's a really big challenge for regulators who are trying to think about ways to bridge that gap to targets. It's not just wind and grids, that would be oversimplifying things. We do also need to scale up things like clean, firm power generation, so an alternative to gas. But certainly, from an analyst perspective, some of the bigger concerns are certainly on the wind side. My second point is that while clean power is important, Europe is actually moving into a very different stage of the transition. It's consumers and it's companies that are going to be the focus and that are going to determine the pace of how the transition evolves. So today, over 44% of our emissions in the region actually come from road transportation and from buildings. This is, as you can see in the turquoise area at the bottom of this chart. So you can see not only how sizable these sectors are, but how slow the pace of progress has been over the last few decades. On the heat pump side, we are going to rely on faster electrification in order to meet climate goals on a least cost basis, and namely with consumers switching to these kinds of technologies. However, as you can see in these charts, there's a really big gap between a base case, where do we get to based on fundamentals, what policies are currently in place, and where consumer adoption is taking us currently based on consumer activity, versus what it's going to need to look like to meet climate goals. And just by 2040 alone, the heat pump fleet, if you like, is nearly twice the size in the climate scenario versus where we're on track for in the base case. Now, I speak to regulators and governments a lot, and they're not ignorant to this reality and how hard it's going to be to accelerate the pace of electrification. And one of the things that they're looking at is obviously tightening things like standards. Obviously, for automakers, this has been a big question over the last coming months. If we look at electrified transport, for example, we know that we're going to need to accelerate the tipping point between where the fleet gets to more than half of passenger EVs being electric versus internal combustion engines by 8 years. So that tipping point needs to be accelerated, and governments are really thinking about how to do that. So how are they thinking about doing this? it's not just the question of standards. In Europe, there's a question on actually introducing carbon pricing that would impact consumers. And this could actually be a very meaningful instrument to stimulate demand. So with the emissions trading system too, the European Commission is now thinking about introducing a measure that would actually potentially encourage consumers to switch to these technologies. You can see in this chart our forecast at BNEF gets to nearly 150 euros per tonne by 2030 for the price outlook. That's based on the current scope and cap of this measure. And if you kind of convert that into the reality of what it would mean for fuel prices, that could be in the range of 10 to 20% for consumers. So this is a real political question at the moment, because many of the questions past the energy crisis have seen consumers raise questions on price pressure. This could be a really important instrument to follow. Now, when we look at what actually could happen in terms of abatement, you can see that the dark turquoise areas in this chart suggest that EVs, both on the passenger side and the commercial EV side, could be the things that step in to respond effectively to that carbon price and bring the emissions that I was talking about that are still in overshoot territory back down. So this is a really big current political discussion in Europe, and one to follow on the consumer side. And I think that alongside other regulatory instruments that are being considered is going to be one to really follow closely. Now, if electrification does scale up at the pace that we're expecting, this could create a lot of opportunities for people across the energy system. So in our net zero scenario, we have a much faster curve of power demand growth compared with our base case outlook. So faster adoption of electric vehicles, faster adoption of heat pumps, and even some green hydrogen production stepping in to help to decarbonize the energy system. Now, this obviously comes with opportunities for generators, but it also comes with opportunities for investment in the grid infrastructure, and absolutely a need to invest in the grid infrastructure. So this, in our modeling, in our net zero scenario, we get to these distinct two waves of investment across the system. So in the first wave, you can see in the blue influx pre-2030, that's all about connecting more renewable energy infrastructure to the grid. In the second wave of investment that's needed in grids, it's all about the demand side and that electrification story kicking in. So this is really important and going to be a really important determinant of how the transition evolves. Now, the final message I want to leave you with today is about how Europe is actually looking quite seriously at the question of decarbonizing industry. And this is something that we've also heard a little bit about today, and I know we'll hear more about later. So industry, much like I just mentioned on the carbon pricing side for consumers, is due to face more exposure to carbon prices this decade. So this is BNEF's EU ETS 1 this time forecast, and you can see that we expect this rebound to 70 euros per metric tonne this year, and then a doubling by 2030 to 145 euros per tonne. Now, Europe is one of a few regions in our global modelling where we actually see industrial-driven abatement as a result of this carbon price dynamic. So this is really critical to understanding how we're thinking about the long-term evolution of industry in the region. Now, rising carbon prices, I'm sorry, this is an incredibly ugly chart, become a game changer for how steel producers and other heavy industrials evolve. So this is just based on our levelized cost of steel production. And you can see that incumbent technologies, so for blast furnaces that are coal-based in Europe, which is the black line, is growing very quickly with the introduction of carbon pricing and actually becoming less competitive with net zero alternatives. So some of the turquoise lines, that would be potentially like direct reduction processes using either CCS or hydrogen. Now, that tipping point is one thing. It's a whole other ballgame to actually invest and deploy an asset that's using these technologies. So the policy regulatory framework is now actually shifting attention in light of the Clean Industrial Deal to maybe introducing new types of subsidy mechanisms and long-term contracts that that these assets could actually get financing through. So one thing that's currently we're tracking is these carbon contracts for difference programs that could be centralized through the European regulatory framework. And this would effectively allow producers to hedge their carbon costs and de-risk some of the investment that's going into low carbon production capacity. Also on the table beyond these incentives could be things like public procurement regulations that, if well designed, could be another demand side tool to help low carbon materials supply in the EU. Currently, I think while these are all positive signals, it's important to recognize that many of the details are very vague, and as was underscored in the panel just earlier, really actually the pace and flexibility and ability of the policymakers to create that enabling environment that allows progress to be made quickly is going to be critical. If we do get the right enabling environment in place, where actually financing does flow into new clean industrial production, we have modeled a scenario where you do see this introduction and influx of net zero clean industrial capacity in Europe. Now, this is a combination of hitting that economic tipping point that I mentioned, but also reliant on that support that would de-risk the technology and help the scale up. So our modelling suggests, as you can see, that we get this rapid deployment both of net zero production across steel, cement, and even recycling capacity for aluminum. Now, the biggest risk factor here to this scenario is not so much just on the supply side, it's also on the demand side, so that curve at the top. And that's because we obviously are in a reality where there's competition for many of these sectors with low carbon production abroad. It was mentioned that there are questions around CBAM and its role going forwards. And I think it's fair to say that, if we don't have stringent enough measures and flexible enough investment into these technologies, that it's not necessarily going to be easy to deliver this at scale and attract the capital needed. But still, as we have seen in clean power, it very much looks like, and the message I want to leave you with, that the fundamentals are going to change very quickly, perhaps quicker than people realize for industrial producers in Europe. So there we go. The clean power fundamentals are intact. We have a real emphasis on consumers as a really critical part of the next phase in the transition, dictating the pace, and that heavy industry is going to have to navigate all of these risks as well as potential opportunities that come with the introduction of carbon pricing and as these new policy and incentive frameworks come into play. Thank you very much for your time this afternoon, and I hope that you enjoy the rest of the event.